everyone, this is Eve Picker. And if you listen to this podcast series, you're going to learn how to make some change. Hi there. Thanks so much for joining me today for the latest episode of Impact Real Estate Investing. My guest today is Jorge Newbery, founder and CEO of American Homeowner Preservation and AHP Servicing. And George is also CEO of Debt Cleanse Group Legal Services. AHP crowdfunds the purchase of non-performing mortgages from banks at big discounts, then shares the discounts with struggling homeowners. George is on a mission to help Americans crushed by unaffordable debts. A 2004 natural disaster triggered the financial collapse of George's former business, leaving him with $26 million in debts he could not pay. George rebuilt himself through AHP, sharing what he learned from his own challenges to help families at risk of foreclosure stay in their homes. George has also found the time to write a few books: Burn Zones, Playing Life's Bad Hands, Debt Cleanse, How to Settle Your Unaffordable Debts for Pennies on the Dollar, and Stories of the Indebted. Be sure to go to evepicker.com to find out more about George on the show notes page for this episode. And be sure to sign up for my newsletter so you can access information about impact real estate investing and get the latest news about the exciting projects on my crowdfunding platform, Small Change. Welcome, George. Thanks very much for joining me, and it's really nice to reconnect.
Likewise, Eve. Always a pleasure.
Yeah, we haven't talked for a while, but still, I know that you're a man with a mission, and the mission that I know about is to help keep Americans in their homes. And I think a more recent one is to help Americans crushed by unaffordable debt. I'd love to talk to you about how you're tackling these two missions.
Sure, they're very interrelated. I'll go back a little bit in history. About 15 years ago next month was a day that kind of changed my life. And at the time, I owned about 4,000 apartments across the country, had a very significant net worth, and an ice storm hit my largest holding on Christmas Eve 2004. And that holding was 1,100 units in Columbus, Ohio. It was just devastated by this natural disaster. And it triggered this extraordinary sequence of events in which I lost everything and ended up $26 million in debt. And yeah, so
that's a really big number.
Created some extraordinary challenges, as you can imagine. But as I regained, came back to life, I realized that I'd become good at one thing through that experience. I never filed bankruptcy, but instead I was able to work with my creditors, or sometimes go on the offensive against my creditors in order to settle those debts at significant discounts, and in some cases, not pay them at all. And by 2008, I realized, hey, millions of families across our country are suffering the same experience. They're at risk of losing everything. They're ending up losing their homes, losing whatever property they had, and in significant debt. And maybe my experience could be put to good use to help them. So I started American Homeowner Preservation in 2008. And the mission was and still is to keep families at risk of foreclosure in their homes. And originally we were a nonprofit. We were able to get our 501c3 designation from the IRS. But over time, we realized that we could be a lot more effective as a for-profit. And we started buying defaulted mortgages from banks at big discounts. And then once we owned the mortgage, we could do whatever we wanted with it, which could include, cutting principal, forgiving delinquency, and reducing payments in order to keep these families in their homes.
So the second mission, I think you started a second company recently, right?
I did. What would happen is over the years, we would help a family and they would say, wow, this is, oftentimes people say this is too good to be true. They owe $100,000 and the homes are only worth $50,000. They hadn't paid in 3 years. They owe $20,000 to the bank. And here we come along and buy the mortgage and say, hey, give us $2,000. We'll forgive the delinquency. So you're up to date. Your payment was $800. Now it's $500. And they'd say, Great. And they tell their friends and family, and the friends and family will call us and say, hey, you helped my cousin's mortgage, my coworkers on their mortgage. Can you buy my mortgage? And the reality is I can't go to Chase or Wells or any of the big banks or other lenders and say, hey, sell me this one mortgage. They basically decide what loans they want to sell, and I can't make special requests. Neither can anybody. So, what do we tell these people? And we started giving them some tips as to what they could do to maximize the likelihood that they could stay in their home an extended period, and somebody would buy their loan at a discount and give them a more favorable deal. And that eventually became a book, which is called Debt Cleanse: How to Settle Your Unaffordable Debts for Pennies on the Dollar. But through life, you find that, as you solve one problem, you create another. So now people would read the book and they'd say, hey, I'm following the steps in the book. They'd reach out. They'd reach out on social media and by email, and they'd say, I'm following the steps in the book, but I need an attorney. Do you know any attorneys who can help me? And I knew from my experience when I was in a lot of debt that a lot of attorneys, some attorneys can be very helpful, but a lot of attorneys aren't that helpful, don't have that much experience in, being, outside of law school. There's a lot of things you can do if you can't afford your debts that can be used to your advantage. Most attorneys aren't familiar with the tactics. And so, what do I do? What do I tell these people to do? I can't tell them just to Google, attorneys in my area. Over time, we realized that, hey, what could work here is a legal plan where consumers struggling with their debts pay $99 enrollment fee and $29 a month, and we give them access to attorneys in their area. And those attorneys, as part of the plan, agree that for that $29 a month, I'm going to give this member half an hour of my time at no extra cost. So they're going to get half an hour with their attorney every month. And not only that, when they first enroll, these attorneys will send letters to their creditors saying that this member is represented by our law firm. Please cease communication with the member and direct all future correspondence to us. And that has been very effective for members at stopping the phone calls, stopping the letters, which oftentimes create a lot of anxiety. So it's a big relief when that happens. But then so that's what we've done. And these attorneys, the goal is they look for violations, and it happens all the time, millions and millions of times a year, where there be live violations of the Fair Debt Collections Practices Act, the Fair Credit Reporting Act, TCPA, RESPA. And when they can find these violations, they use this as leverage to get the debt settled at big discounts, not get paid at all in some cases, and they'll sometimes even get the creditor to pay the member a statutory penalty plus pay the attorney's legal fees. So most of the attorneys work on contingency, so they're not looking to get paid by the member, they're looking to get paid by the creditors.
So I want to go back to AHP servicing and what you've done there. And I haven't talked to you in a few years, but I know you were buying large blocks of foreclosed homes and trying to keep people in them. That was really your first goal. And I'm wondering how many people you've impacted by now. How big has this become? Where does everything stand?
I think we bought over the years about 10,000 mortgages. So it's grown, we bought a lot of mortgages. We've helped, thousands of families stay in their homes with long-term sustainable modifications. Others, they don't want their homes. We've been able to give them cash, in exchange for the deed to the property. We forgive the debt and then we sell the property. And so we get these vacant homes, which are oftentimes pockmarking low and moderate income neighborhoods, and we get those back into service and occupied, and someone's taking care of them, paying taxes on them and whatnot. So between the two, one is keep the family in the home if they want to stay. Number one, that's the goal. But if not, the second thing is to help those communities by getting these vacant homes back into service.
And so let's talk also about how you fund this, because that's how you and I know each other, right? That's probably the most interesting part of the story, or very interesting.
Yeah, that's how our paths intersected. So in 2013, September, we were one of the first crowdfunding offerings under 506C. And before that, we raised money initially from friends and family, then from private investors who we knew, then accredited investors only into a hedge fund. But then we heard about crowdfunding. And so September 2013, we offered under 506C. It was still accredited investors only, but we made it more accessible. It was $10,000 minimum, which at the time was pretty low. And I think our first offering raised about 4.5 million or so. And we bought a considerable number of loans. I forget how many, but it was quite a few, probably close to 1,000. And it worked. It made it more accessible. It was still accredited investors only, but it made it more accessible to a wider audience. And I remember being really shocked early on when people would go online, go through the process, make an investment, and we had never talked to them. And I was really astounded by that because previously as a hedge fund, we had to talk to people and explain things and send out these private placement memorandums that were numbered. So it really seemed to be it was just a lot more streamlined. But what was exciting is we did 2 more 506C offerings, all went well. But then when we heard about Regulation A+, because now it was crowdfunding, but we could accept investments from both accredited investors and non-accredited investors. And for me, that was exciting because it really, we had homeowners at times who we helped them out of their predicament, and they'd say, hey, I have some extra money I'd like to invest, or my friend or family member would. And I can't tell you how many times we had to tell people, we'd love to have you participate, but you can't. You're not worth enough, or you don't earn enough, so we can't accept your investment. And it seemed
you're part of the 97% of the population that's not permitted to invest, right?
Exactly. So that it didn't feel right. So when I heard about Regulation A+, I'm saying non-accredited investors can invest. That was exciting. And so we were one of the first Regulation A+ offerings in 2016. And to make it as accessible as possible to anyone, we made our minimum investment $100, which I think is still amongst the lowest, if not the lowest.
Be sure to go to evepicker.com and sign up for my free educational newsletter about impact real estate investing. You'll be among the first to hear about new projects you can invest in. That's evepicker.com. Thanks so much.
Any other major ones?
I think it's probably the lowest. Although there's some pretty low ones in Reg CF, but it's pretty low.
Yeah, it's pretty low. And people would say, well, why are you doing that? You don't need to be that low. And the reality is we don't need to be that low, but it did make it, it caught people. It was almost a marketing strategy, but we've kept it because many people have started out with $100 just saying, well, what is this? It looks curious. Oh, it's only $100. I'll try it. And now they're an investor with us. They get our emails. They see that they get the returns and they keep up with our news. And then over time, the vast majority increase their investments, and then they tell their friends and family. So it definitely, the $100, I think is a winner. I think we'll do it forever. It's a great way to start a relationship. And that's grown. So now our first Reg A fund, we raised $40 million. And now we're working on our second. Our goal probably would be to get to around 65 million. And then, our third fund, which will come out sometime mid 2020, we expect, our goal is to do the full 100 million. Regulation A+, we actually now have realized that vision of having homeowners who we helped out of their predicament, and now they've turned around and been investors. And I think it just feels right. It is. Yeah. It's socially, it seems right. And it feels good. And that's along with, a lot of other, we have a lot of accredited investors that participate, but alongside the non-accredited, and we've had people invest very substantial sums, several $100,000 at a time. And they've asked, hey, can I get a better deal? Or can I get, a little bit extra or something like that? And we always say no. Again, it plays to kind of
it's because everyone's money is the same, right?
It is, exactly. So
it's a great democratization of investment.
It truly is. The person who puts in 100 and the person who puts in 600, they're getting the exact same terms. And I'm talking 600,000. So it's fair, it's transparent, and that's the way things should be. And I know in Wall Street, it often isn't the case. So yeah, it feels good.
So while you've been, helping people save their homes and, taking people's money to make that happen, how much have you been returning to investors?
I'll tell you what we did in our first fund, because it's kind of you'll see the progression. In our very first 506C offering, we said, hey, if you invest your money for 5 years, you earn 12%. If you invest your money for 2 years, you earn roughly 10%. If you invest your money for 1 year, you earn 9%. And that was our first offering. And that's what we did. And then in our first Regulation A plus offering, we said, let's make this simpler. Let's just pay everybody 12%. But if they need the money early on, they can ask us for it, and we'll undertake our best efforts to return the money. And if they need it back, I think we did currently, if they needed it back early, then they get a slightly reduced return. And that's evolved into today's fund, where we pay the first 10% of what we earn. That's what we pay to investors. Anything over that is what we keep.
So that's pretty motivating for you.
Yeah, it's very motivating to hit big targets. And again, there's a tension between you want to make money, but you also want to deliver a very favorable resolution to the homeowners. And we make everything formulaic. So I think our returns come from creating efficiencies in resolving these, and speed, urgency in resolving these, and trying to minimize legal fees and other expenses in getting these resolved. And when we do that, that's when we generate the big returns.
Wow, that's quite a story. So by the time you've raised all three funds, how many mortgages will you have purchased?
Yeah, that's a good question. Right now, I think we're right around 10,000. I think we will certainly, if we do all three funds, it should hit 30,000 plus. I mean, in the current funds, in future funds, in our current fund, our AHP servicing fund, we can buy mortgage servicing rights. We haven't done that yet, partially because we're still waiting on getting our government approvals for our servicer. We did get recently approval from the Veterans Administration to service VA loans. We're working on getting our FHA, Fannie Mae, and Freddie Mac approvals. Once we have those, we can buy mortgage servicing rights, which actually we'd spend a lot less money per loan for the ability to service that loan. But then we can service it, with our homeowner-friendly strategies, which will, I think, touch a lot more homeowners. So we will, actually the amount of loans that we will own or service will expand, could be much, much more than that. And I don't have a number yet, but I think as we start seeing buying those rights, and then also we're servicing now for third parties. So other people that own mortgages.
Oh, really?
Yeah, that we see that as another way we can impact a lot of homeowners and do what we've been doing, but for other people who own mortgages, and are also kind of it's funny. And I think you may have experienced this in your undertakings as well. Oftentimes people interpret socially responsible or social impact as meaning, okay, I get the benefit of doing something good for society, but I have to take a lower financial return. And I think, at least in our business, we've demonstrated that you can actually achieve both a solid, oftentimes above market financial return, and you're also doing the right thing. They're not mutually exclusive. And I think other investors now see that own these loans, and we can help them in their interactions with the homeowners if they service with us.
So then, do you believe that most of your investors are investing because they're making an impact, or because of your solid returns?
That's a really good question. I think it's a mix. There's definitely people who are attracted by the financial returns, but there's others who are investing, the draw is the social impact. And since we've been able to marry the two, I think it's been, they don't have to compromise I think so many times social impact investors feel the need upon occasion to compromise their financial returns because it has a good result. And that's certainly understandable. But when you can deliver both, I think that makes it very compelling.
So going back to the beginning of this story, I'm just wondering if you could have built this business with bank loans instead of crowdfunding investment.
I don't think so. We're still doing it. I think we qualify for some we financed. We've done some financing here and there. Usually it's only for short term, like we committed to a deal that's bigger than that we're raising capital, and we need to close it by year end or month end or something like that.
A bridge loan, right?
Yeah. So we'll borrow, but it hasn't been for long periods yet. Over time, we've talked to Wall Street investors, or I should say Wall Street institutional potential partners. And for this space, for non-performing loans, they're most interested when the scale is bigger, and we're talking like 100 million, and we're just not there yet. Over time, I think we will have more institutional capital in here, and we blend that with the equity that we've.
But George, by then, maybe you'll have such a big crowd of investors, you still won't need them.
Maybe we'll see. I guess the attraction is we can get institutional money, sometimes you can get it at even lower returns than what we're paying our investors. So maybe it would make us more competitive on some of the larger transactions. But you're right.
Yeah, that's what I hope for. So going back even further, like you had this portfolio that was hit by an ice storm, but what's your background? What got you into all of this?
I started as a loan officer almost in 1990, so a long time ago. My first job was answering phones for a loan originator, and that was my first exposure to real estate. Before that, I raced bicycles and I had a GED. So my options were limited when I was 25, and my main source of revenue was bike racing. And so I needed to get a real job. One of my teammates' girlfriends helped me get the job at the loan company, and that was kind of the start. A couple years later, I started my own mortgage company, and then I started buying properties, and it kind of evolved into buying and doing. I'll share a strategy though that's been a consistent. As I've learned, and it's still what we do today, is I always buy what other people don't want. And so when I first started in real estate, we would do loans that other people wouldn't make. And then I started buying properties that others didn't want. And these would be mostly because they were in less desirable areas, neighborhoods. They'd be challenged properties that were maybe the target of, had been vandalized or were a blight on the community. And I found that you could achieve a good social impact when you remedied whatever the problems were, and you could also make money doing it. And that was rewarding to me. And I always like a challenge. So, the bigger the challenge, when people say, oh, this can't be done, then it's kind of like, okay, well, I get to prove them wrong. And so even today, Wall Street does not like to buy the loans that we like to buy, which is those secure in low to moderate income neighborhoods with, our average home value that we buy is $40,000 dollars. And that's just Wall Street. They'll say, hey, congratulations, George, you just made $6,000 on that deal. It doesn't mean anything to them. But for us, we make $6,000 on 100 loans or 1,000 loans. And you say, wait, now we have a business. So we buy what others don't want. And that's, I think where there's some success. I mean, today we're working on a deal right now to buy the debt on 3 churches. Again, and these are 3 churches in kind of serving low to moderate income neighborhoods. And it's another opportunity for us to buy the debt. And no one wants to foreclose on a church, and including us. So our goal will be to make those loans affordable for the churches so they can continue operating. But 90% plus of what we buy is loans secured by homes. But when we see these opportunities, like, no one wants to buy that stuff. So we'll buy it. We'll buy it at a substantial discount, and we can add value by working directly with the church to get the loans back on track.
And so, I think, as I'm listening to you, I'm realizing this is I've been talking to a lot of different people about different ploys around how to fix the affordable housing crisis. And this is such an effective one because it's keeping affordable housing, actually making it more affordable for people who really need it without actually building anything. Pretty dramatic impact, I would say.
Yeah, the housing's there. It's just making it affordable and keeping people in it. And so many people in the last housing boom, in the early 2000s, took out big loans. And then when the values crashed, I mean, unfortunately, these neighborhoods have not recovered in to large extent. Whereas the rest of the country has recovered. The only segment of the market where values have continued to deteriorate is those mortgages or those homes whose values are $50,000 and less. And there's a number of reasons for it. A primary one is Dodd-Frank, and Dodd-Frank was a well-intentioned bill, but it really strangled new mortgage capital from going into these neighborhoods, which basically, they made some very tight constraints on what could be charged on to originate a loan in these neighborhoods or everywhere. But when you get a loan of $50,000 and you can only charge 5%, and then it includes a lot of the fixed costs, it's just no loan agent, no mortgage company, by and large, no one wants to do it. It's you're working for very little. So why not spend your time on a higher value mortgage? And so that's made it so that most of the properties that are sold in these lower value neighborhoods get sold for cash, and most owner occupants don't have cash. So then you end up being sold to investors who rent them out, and then it's majority rentals. And then the banks, a lot of mortgage holders see, hey, it's not even worth it to foreclose. And then you have all these homes that are sitting there with $100,000 mortgages that are vacant, getting vandalized and deteriorated, and are now only worth 10 or 20,000, which eventually they get foreclosed on, they get sold to investors. It's really left behind a whole segment of our population, at least real estate wise, and I think a driver in the widening wealth and income gaps in our country.
So, in the work that you do, you're working in neighborhoods where people must be pretty angry. And I'm wondering what sort of community engagement tools work for you.
We have a very simple one, which we started in 2010, 8 years ago, especially at this point. So many of these, to your point, so many families who are struggling in these neighborhoods have already had overtures from Bank of America, Chase, who's ever owned their mortgage before us. And they've said, oh, we could do a modification, we can do this, we can do that. And then when they go through the process, they're oftentimes left disappointed. Bank of America will want, they'll ask for tax returns, bank statements, paycheck stubs, all this stuff. And it's sometimes people are working, doing babysitting or doing, helping. Their income is untraditional in some cases. And I mean, that goes for all segments of society, but for some of these families where, hey, I run daycare, but, oh, we need your daycare license. Well, I take care of friends and family's kids. And I mean, there's things, they just don't qualify. And there's no real, for these families, now they come to us and they explain what the situation is and it makes sense to us and we do it. It's not like we're not bound by some criteria that a lot of the big banks are. And I think that's given us a big advantage. But to reach them, so now we own their mortgage. So of course they're thinking we're the bad guy, but we send a letter, one-page letter that says, here, we just bought your mortgage. Great news. Here are your three options. If you want to stay in your home, we will accept $2,000 to satisfy your delinquency, which oftentimes is $20,000 or $30,000. So you pay us $2,000, you're completely up to date. Your existing mortgage payment is, for instance, $800. We will drop it to $500. So that's option number one. That's a modification. Number two, if you don't want to stay in your home or you've already moved out, we will pay you $1,000 and you sign a deed in lieu to us and we'll forgive the rest of the mortgage. And the third option is if you want to settle your loan for a lump sum, then we will accept this amount. And we give them the actual amount. So let's say they owe 100, the property's worth 50, and we bought the loan for 20 or 25. We'll probably say we'll settle it for 45,000. So those are the three options. And so it's very simple. If you call in and you say, I want to do any of these options, we're bound to it. We're going to take it. And so we have people, it's so simple. We're not asking for tax returns, bank statements, any of that kind of stuff. And people literally call in and say, yeah, I got your letter. I want to do option number two. It's like, they've already decided that this is what I do.
I would have thought you'd need someone answering the phone, like to questions like, is this for real?
Yeah. Well, after we get over that, sometimes then we do get those questions. Definitely. Is this for real? Is this a scam? We get all those questions. Sometimes we have to give them the assignment that we got from their lender, but oftentimes we direct them online. They can Google us and see that, hey, we're really what we say, who we say we are. But yeah, it works. It's so simple. And it's funny. We've been doing this for years and no one else is still, I thought, oh, this is our secret sauce. Someone else is going to steal it, but no one's stolen it. Everyone, it's just like, they're all so rigid, the other lenders, and they're set in their ways. It's amazing that this is such you can simplify things. I imagine it'll work for all stratas. We primarily do loans in low to moderate income neighborhood. That's what we buy in those neighborhoods, but in higher income neighborhoods, I imagine they would also appreciate the simplicity, but still everybody else still does it. We want tax returns, bank statements, all that stuff. And that's just, it's a hassle. It's like a big block. And, people,
if someone's got 2 or 3 jobs to make ends meet, they're just not going to get it together.
Exactly.
Yeah. I can barely get it together.
I know. Whenever somebody asks my tax rate, it's not that tough to get it, but it's like, okay, let me dig them out. And then you send them and then, I want a paycheck stub. And then you want this and that. And the banks, it's crazy. The banks actually ask these families who've been struggling, they'll say, oh, we need a hardship letter to say why you fell behind on your mortgage. I mean, and then it's like you're getting graded on this thing. Just they're behind. I mean, they lost their job. There was a divorce, a death in the family, an unexpected medical expense, any of these reasons, but does it really matter? I mean, they're behind. No one's in my life. I mean, people don't fall behind. No one wants that. Everyone wants to pay their bills and be on time and not have to go on with focus on other parts of their lives. They don't want to fall behind. So you don't have to kind of shame them. I feel like some of the banks almost, the process they go through, it's almost like they shame them for falling behind. It wasn't something people wanted to do.
Yeah. Wow. So, you found this little corner here, actually a really big corner. And so what's next? I'm sure I've got to believe you're thinking about other things.
2 years ago, we started our AHP servicing and actually went operational just over a year ago. So now we service our own loans. So that's new. We always used to have to rely on a servicer. And we're doing a couple things now that's, I think, our big step forward. And what we want to do is to get government approval to service government-backed loans. That's a market that we haven't had too much exposure to, but we think we can do a lot of good. And a lot of people with VA and FHA loans, for instance, are oftentimes in our target neighborhoods and they're struggling. So we think we can help a lot of these families once we have those designations.
And is it hard to get that approval?
It's a little bit of work. You know what? It feels like applying for a modification at a bank. No offense to FHA and VA, but it does. They're asking for all these documents, this explanation. It's like, but we're getting through it. We got VA done. Now we're kind of on FHA. But yeah, it is a lot of work. And I guess they want to know who you are. They want to make sure you have all your licenses and all your credentials and all your bonds and everything like that. Everything lined up. So totally understandable. But it does. It's not the funnest process.
Okay, well, I'm going to go back to like big picture a little bit and just ask you, where do you think the future of real estate impact investing lies?
Well, I know where the need is. And so I guess the future will lie in solving the need. But as you and I have talked before, housing is unaffordable for a huge chunk of America. And we have to remedy that. And I don't know there's all kinds of remedies for that, but that needs to be fixed. And we can't, in these low to moderate income neighborhoods, and I can think of locally, I'm in Chicago, so South Side Chicago, West Side Chicago. I mean, there's definitely some of those communities in those areas need help, and East Cleveland needs help. And these homes, there's homes out there selling for $20,000, which seems, well, that could be affordable. If someone had a mortgage on a $20,000 home, that payment's going to be a couple $100 or something like that. Very, very affordable. But no one's providing financing for those loans. So then, investors come in, they buy them, they do a little fix up and they rent them out. And that's not rebuilding the community. It's helpful that somebody's at least occupying the home, but it would be nice if you get more homeowners through financing to stay and move into and own homes in these lower income neighborhoods. I mean, that has to happen. It can't stay as is. It's just going to get worse. Because what happens right now is somebody who decides, I want to buy a home, and they go to a loan officer and, hey, I want to buy this $40,000 home. And the loan officer say, I just can't finance it. Why don't you buy a home that's maybe $80,000 in this slightly more expensive neighborhood, and we can finance that. And so then the people that can buy homes, now they're buying homes in the slightly more expensive neighborhoods, and these really affordable neighborhoods are just getting more and more abandoned. That has to stop. And so that's, we're doing what we can because we're buying a lot of our loans are secured by homes in those areas, but there needs to be a solution to that. The inability or unwillingness, or really the legislation that created the inability or the undesirability for lenders to loan in low to moderate income neighborhoods. And it's almost redlining, except it isn't redlining. It's just, hey, we don't make any money doing it, so we're not going to do it. And it's hard. I guess it's hard to argue with that, but that has to change.
Interesting. Yeah, it does have to change. So that's really interesting. I wonder if you could do a huge Reg A raise and simply provide mortgages.
Actually, believe me, it's crossed my mind. I mean, the thing is, we'd have to do a Reg A that would be, then you want to provide the rate, you want to provide really affordable rates, or at least market
Right.
rates, 5% or something like that. So you have to pay the investors
Less. So,
less. That becomes less desirable.
I've thought about this a lot too, because we see small change, a lot of people coming to us with new, larger affordable housing projects. And of course, to keep them affordable means that they're subsidized and that they really can't provide much in the way of return. And I've thought a lot about who's out there who would invest in that. There have to be people who invest in that. And the interesting thing to me was the little project LA Bungalow Gardens that was on our site, which is only eight units for formerly homeless people, raised money faster than anything else on our site did. And I'm pretty sure it wasn't because of the return. So someone has to have the guts to test it.
Yeah. And what was, out of curiosity, what was the return?
They actually offered 9%, which was very nice.
Yeah, that is. So you're not
upside, because they're keeping it, the asset value is not going to increase. It is going to be set as affordable housing for the next 15 years. So it's really, its preferred return is almost like an interest on debt. You and I should talk about this offline.
Yeah, agreed. It's a problem that needs to be solved. And it is, I guess that would test the willingness you're going to pull out the investors who are investing in some of these crowdfunding opportunities that both of us are involved in purely for the financial returns would probably fall to the wayside. So it's going to really test the ones that are really socially driven and now are willing to take a reduced financial return. And can that be done on scale? I don't know.
Someone has to test that. And let's talk.
Yeah. I mean, so think about that just for fun, because it's kind of interesting challenge. So if you did a regulation A+, it's going to cost $75,000 legal fees, accounting, to get there. And then you go to market and oops, I went to market at 3% and it just the market wasn't there. That would be challenging. So I don't know. It would be nice to do it on a test on a small scale and see.
Isn't there an attorney out there who's listening who would do this pro bono for us?
Maybe.
I mean,
let's hope so.
Enough who would help us, do this offering pro bono, and then we could, or take a deferred payment later when we're successful.
That may be the case. Maybe that's necessary.
I've got a platform.
Yeah, exactly.
Let's talk about it.
Yeah, absolutely.
Okay.
It's an interesting, and it's certainly any of your listenership, if you have ideas, I think contact Eve.
I'm completely derailed, but so I did have a couple of wrap up questions for you, and then we'll all wrap up. So what do you think is the key factor that makes a real estate project impactful just to you?
It has to solve a real problem, a real need. And I think that's the key factor in any business, any undertaking. There needs to be a real problem that you're solving. And there's plenty of problems in this country to solve.
Okay. And the second question, because I ask everyone these three questions, is how can involving investors through crowdfunding benefit a real estate developer beyond just raising money for them?
You get a lot of people rooting for you that now have a financial interest. So now they want to see you perform. They want to see you succeed. And it's not just you or you and your banker or you and your one big investor. It's like now there's a whole crowd saying, I want small change to win. I want this project to win. I want this project that I invested, $500 in this that's helping the homeless in LA that you mentioned. I want that project to win. So you have a lot of community members and just people that are out there cheering for you. They've done it with their money, but they're out there on the sidelines rooting for you. I think that's helpful. And certainly if you were to ask investors, our investors will sometimes volunteer, hey, what about this? What about that? Have you thought about this? And they're doing that. Some of them will probably do it just because they want to be helpful, but because they have a vested interest in your success, I think you get more of that.
Yes. Yeah. And then finally, if there was one thing that you would improve about real estate in the U.S., what would that be? Oh,
we touched on it. The affordability for the everyman, and especially those that are of modest means, that has to change. I was in Austin a few weeks ago, a massive number of homeless. I think it has the third largest homeless population in the country. Austin, LA, San Francisco. Chicago for that matter. It's really cold right now. So if I were homeless, I'd probably migrated out of Chicago because it's just so cold sometimes. But some of those Texas, California, I'm sure it's everywhere. I mean, but that to be as powerful and wealthy of a nation as we are, and have so many people on the fringes who are not surviving. I mean, that's not. I don't look at it as their fault. I think that's our fault. That's society's fault. We need to build a better society so that doesn't happen.
Yes, I agree. So on that note, we're going to say goodbye, and thank you very much for joining me.
Thanks, Eve.
That was Jorge Newbery. If anyone else is trying to recover from a $26 million loss, they'll likely get a few pointers from George. He did not file for bankruptcy when financial disaster struck. Instead, he painstakingly worked his way through resolving his debt, and then he rebuilt his life on what he learned. To date, 10,000 homeowners have benefited from George's life lessons and his good heart. You can find out more about impact real estate investing and access the show notes for today's episode at my website, evepicker.com. While you're there, sign up for my newsletter to find out more about how to make money in real estate while building better cities. Thank you so much for spending your time with me today, and thank you, George, for sharing your thoughts with us. We'll talk again soon, but for now, this is Eve Picker signing off to go make some change.